And we're going to do some fun videos too. Like we're going to be attending a cannabis event. I believe it's next week or the week after. So we're going to be in Toronto. What's that?
It's going to be at the CN Tower?
Yes, sir.
Yeah, look forward to
that. Our media passes and we're
Sweet.
ready to roll for that. So we'll shoot a cool vlog again. I'm excited.
100 likes and I'll get kicked out.
What's going on, guys? Aaron here from Deprartures Capital I always mess it up like 15 times. Take two.
What's going on, guys? It's Investing Hustler here. And with me, I have Aaron from Deprartures Capital. How's it going, Aaron?
It's going great.
So today, me and Aaron, we're going to talk about earnings report that are coming up for 2019 marijuana earning reports. So we're going to talk about which earnings are coming up. So I got a couple ones that are coming up. So Canopy Growth is coming up on February 13th, 2019. Aphria's next earnings are coming on January 11th, 2019. So that's very, very, very soon.
Yep.
And even Planet 13 is coming up on February 26, 2019. And I know Aaron has a couple earning dates that are coming up also.
Yep, we got Aurora coming up on February 7th, and we got Tilray February 12th. So it's going to be a very interesting next 2 months for the cannabis sector and earnings.
This article is by, of course, the Molly Fools, and it's titled Marijuana Earning Reports Are Going to Be Particularly Tricky in 2019. I guess we're just going to let you guys know this is a Motley Fool's article. So I enjoy reading them because they usually do have good opinion. Let's get started. So last year will almost certainly go down as the greatest in history of the marijuana industry. In October, after many years of promises from Prime Minister Justin Trudeau, Canada legalized recreational marijuana, lifting the curtain on what had been 9 decades of prohibition. When fully ramped up, we should see upwards of $5 billion in annual sales added to the industry. The U.S. cannabis industry delivered plenty to cheer about as well, with the Farm Bill being signed into law, thereby legalizing hemp and hemp-based cannabidiol, and the Food and Drug Administration giving the green light to the very first cannabis-derived drug. You could slightly say that the marijuana industry is flowering right before our eyes, but as we barrel into what's traditionally the kickoff for earnings season, marijuana stock investors are going to have their hands full, more so than the average investors. Where areas most operating results tend to be straightforward with non-cannabis companies, pot stock investors have a few extra things to worry about.
IFRS accounting adjustments to begin with Canadian-based marijuana stocks follow international financial reporting standards, which are different from generally accepted accounting principles. GAAP, you're probably used to in the United States when it comes to marijuana stocks, which are treated as agricultural companies. IFRS accounting leads to some of the wackiest revisions you'll ever see in an income statement. It begins with recognizing the fair value of biological assets. That's pretty much a fancy way of saying that the marijuana growers have to make an educated guess on how much their crop is worth based on the current stage of the growing cycle. That's right, as cannabis plants grow, flower, are harvested and processed, their values can change. Growers need to know that the change throughout the growing cycle by adjusting the value of their crop. If that's not enough, growers are responsible for factoring in the expected cost of goods sold. This estimate is almost always done well before the company has actually sold the product. And as the icing on the cake, this fair value adjustment is done above the line. This means should the adjustment be a positive number, it could turn cost of goods sold, which is an expense we'd subtract from total revenue, which is an expense we'd subtract from total revenue into a positive number that gets added to revenue, thereby leading to a higher gross profit. With growers in a state of rapid capacity expansion, IFRS accounting is likely to lead positive fair value adjustments and, as a result, positive earnings per share in some instances. For example, hydroponic giant Canopy Holdings has recorded $29.5 million in Canadian dollars in sales through the first 9 months of 2018 to go along with $9.2 million in costs of goods sold. That's a gross profit of $20 million. However, Canopy recorded a $17.2 million fair value change in inventory sold that adversely impacted the gross profit, and a $41 million unrealized gain on changes to the fair value of its biological assets. Ultimately, Canopy has generated an IFRS accounting-based gross profit of $44.8 million, despite reporting just $29 million in sales. What investors are going to want to do is remove the fair value adjustment when analyzing pot stock operating results. In particular, you'll want to hone in on operating results without a bunch of one-time benefits and costs to get a truer look at how well or poorly a marijuana stock is performing.
Accounting for equity investments and other one-time costs and benefits. So also annoying are the number of possible one-time benefits and expenses that marijuana stock investors may need to sift through when examining the income statement of a publicly traded weed company. One perfect example is brought to us by Aurora, the grower projected to lead the fields with perhaps 700,000 kilograms to peak annual production. When Aurora reported its first quarter operating results in November, it dazzled with a Canadian $105.5 million profit. Of course, this turned out to be mostly smoke and mirrors if you dug below the surface. The bulk of Aurora's gains came from adjusting how the company recognized its influential investments in the Green Organic Dutchman, having previously been treated as an investment in associate, which was reported at cost. Aurora's investment in the Green Organic Dutchman is now considered a marketable security and reported at a fair value. This change, along with derivative gains, resulted in Aurora's quarterly profit on an operating basis that purely looked at revenues and operating expenses. The company lost $111.9 million. Moving forward, Aurora Cannabis is likely to continue losing money on an operating basis as it expands in production capacity, makes acquisition, which can have one-time costs of their own, and build up its recreational cannabis brands. My suggestion is, if you didn't catch it in the previous point, is to avoid the one-time benefits and expenses. Instead, focus your attention strictly on total sales and aggregate operating expenses.
Yeah, that was so true for T-God.
Yeah, they
All
make
right, I see Oxy mentioned in here, so I'm interested to check this out. Share-based dilution. Marijuana stock investors also need to account for a necessary evil that's allowed pot stocks to expand as quickly as they have. Share-based dilution, aka, you know, some of the big ones like Aurora too. They have some dilution, but it allowed them to expand, which is good in a sense, but not for shareholders for the short term. Most cannabis companies have very limited access to non-dilutive forms of financing from banks. This means their only source of readily available capital, other than what minimal operating cash flow they may be producing, is bought deal offerings. A bought deal offering involves the sale of common stock, convertible debentures, options, and/or warrants to an investor or group of investors. While this method has been wildly successful in raising money for capacity expansion and acquisitions, it is a nightmare for shareholders. It weighs down on the existing value of a company's share price, and a larger number of outstanding shares can lead to earnings per share adjustments. Take Oxy Cannabis Group, which began as a royalty company that provided upfront cannabis growers looking to expand and in return would reap the benefits of receiving a percentage of production at a below market cost. Today, Oxy is a vertically integrated business with what it considers upstream, growing, midstream production, addition, and diversification, and downstream retail operations. But Oxy has yet to realize much in the way of revenue, given that many of its partners won't come online until 2019 or 2020. This means Oxy has been reliant on selling its own stock to raise capital. Over the past 3 quarters, Oxy's share count has risen from 263 million to 565 million, which is almost double. That's not good news if you're a shareholder, which is why Oxy is down so much. But I still do like Oxy. More importantly, though, through the first 9 months of 2018, Oxy lost 7 cents per share, which appears to be only marginally worse than 6 cents per share it lost in the previous year through 3 quarters. But a quick look at the company's comprehensive loss reveals that it lost 28.3 million through Q3 2018 versus 8.8 million through Q3 2017. That's not marginally worse. A higher share count has simply given shareholders the impression that things are only a bit worse, when in reality the company's comprehensive loss has more than tripled. Investors are going to want to pay close attention to net income and loss figures and somewhat ignore earnings per share until the rampant dilution ceases. So that is a very good point.
So it pretty much just touched up on Aurora. I thought they were going to touch up on more companies because it was titled Marijuana Earning Reports are going to be particularly tricky, but it seems like they were talking about mostly, I guess, Aurora and how they acquired T-God or invested into T-God.
But I guess what they're trying to say in this article is the fact that, like, Aurora is a great example of that. But I mean, you've got Canopy Rivers with Canopy, you've got different investment vehicles, and they're just saying that, you know, these companies, you know, we're investing in them because they're marijuana growers and we expect them to make money growing, but don't count those one-time strategic investments where the company's made a lot of money as a sustainable way for the company to make money in the future. At least that's what I think they're trying to say.
Yeah.
So
I'm surprised they didn't really talk about how this will be the first ever full quarter where recreational marijuana will be taken into place with their earnings. They didn't mention nothing about that because I think that's going to be pretty important. I guess I kind of do agree with most of the article. It's going to be interesting. So we're going to have to see how this plays out, and we already said when the next earnings will be. Just
Yeah.
in case you guys missed it, February 13th, 2019 will be Canopy's earnings. January 11th will be Aphria's, and I think it was the 29th for Planet 13. I
Yeah.
don't know what happened. I lost it.
And then Aurora is the 7th of February and Tilray is the 12th of February.
Do you think we could just wrap it up here, or you want to continue into the next
No, I
one?
think that's good. I mean, it definitely did show three things to take a look at. And I definitely agree with the fact that like the companies, you shouldn't really like, oh, say for example, Canopy stumbles across a company that they like and they invest into it and they make good. Like it's not like that's going to consistently happen every quarter for the earnings to be good. Nor do I feel that Canopy or Aurora they're not purely investment companies. Like that's more so what Canopy Rivers and Australis Capital should be trying to do. Although both of those stocks are down. Like just to wrap this video up, can we just compare Australis Capital and Canopy Rivers? Because they're two investment vehicles that are supposed to be investing in. They're like basically a venture capital fund in the cannabis sector. This is coffee in a seamless wine glass.
So Australia's capital right now, wow, they're up 21%.
Yikes! They're over $1. Oh my gosh! Wow,
Look
that's a miracle.
And then
Look
Canopy,
at that IPO though. Look at that brutal IPO.
that was pure manipulation at its finest.
That was the worst IPO I've ever seen, and
And
I
then
remember when
Canopy
people were trying to
Rivers
defend it.
hasn't even moved. But they both well, I guess that wasn't the IPO. I don't know why Canopy. Oh no, I feel like this was prior to IPO. I remember I don't actually remember. I feel like Canopy Rivers IPO'd at like around $10.
It
I'm
did
not even sure.
something around there. It definitely did because it IPO'd in September when I was on vacation. I remember.
Exactly. And this right here is September. So I
Yep.
feel like this right here was like I don't know. I don't know why it would show it. It was like when it was private. Who knows? And then we'll go back to Australia's capital.
They were another company. I'm pretty sure there was like a reverse takeover. A lot of these companies did RTOs to change
Yeah.
them from mining companies or pharma companies into cannabis companies.
Fuck man, I can't believe it's it IPO'd at $15,
16.
$16. Holy crap! Pretty much instantly dropped all
Yeah.
the way down to I guess around the 50 cents, 50
That's
something.
brutal. That chart's like worse than IGC. You know what I mean? I mean,
Watch them go back up to 15 now.
could these companies regain some steam potentially? Yeah, because I mean, it could take some time for them to.
Look at that. It's a strong buy. Damn, it's a buy all around. It's a buy.
But like
Buy,
they were selling warrants for 25 cents, or I think the warrants were for 25 cents. Like they weren't selling them for 25 cents, sorry, but they had warrants for 25 cents on Australis Capital and it IPO'd at 16. Like that's nuts.
Yeah, so it's not the whole market. It's just the penny stocks are buys right now.
Yeah, small caps are leading the rally right now.
I can't believe it. It's I didn't even notice that. It's up at $1.05 now. That's good for them.
Yeah, that's insane. Holy smokes.
If I break even, I'm just selling my. Actually, no. At this point, there's no point.
Yeah.
Just hold on to it, because those shares that we got were for free, right?
Yeah, exactly. Exactly. So if you like videos like these guys, toss us a like, hit that subscribe button, hit that notification bell for Investing Hustler and Departures Capital, and we will consistently bring you more and more update videos on cannabis sector, different sectors of stock markets, investing, any way to make money in 2019. That's what we're all about. And we're going to do some fun videos too. Like we're going to be attending a cannabis event. I believe it's next week or the week after. So we're going to be in Toronto. What's that?
It's going to be at the CN Tower?
Yes, sir.
Yeah, look forward to
We've got
that.
our media passes and we're
Sweet.
ready to roll for that. So we'll shoot a cool vlog again. I'm excited.
100 likes and I'll get kicked out.
And there's a cocktail party. So look out for the after party. It might get a little bit crazy.
Nice.
So yeah, we'll set that up. We'll probably live stream for you guys when we're there. We'll do a bunch of fun stuff. So I'm looking forward to 2019. Anyways, that wraps up this video, guys. Once again, 100 likes, please. If you like this video, hit that like button. And
And leave us a comment. Let us know what you think about cannabis earnings, how they're going to be.
yes, sir.
So we'll see you guys next time.
Bye-bye.